Hello and welcome into the KE Report. I'm your host, Chad Markwitz, and I'm speaking today with Justin Huhn, founder and publisher of Uranium Insider. And Justin is one of the most prolific guys in the space, in the sector, talking about the uranium markets, nuclear fuel markets, and really the growth and supply demand side of the nuclear power industry. I guess, Justin, let's start off on the big picture and then we'll work our way down into the companies throughout the discussion. But I'll just throw it over to you generally. Some of the big supply demand drivers that you see right now, as far as reactor builds, where is the demand coming from? Some new reactors coming online. Any thoughts on the demand side of the equation?
The demand side is certainly growing a lot faster than we had projected just a few years ago. A lot of that growth is coming from China as far as new nuclear, but we're seeing new builds being announced all the time and plans for new reactors on a weekly basis and sometimes on a daily basis. So, for example, the United Arab Emirates, probably the success story for new nuclear of this century, the Baraka plant. These are four 1,400 megawatt reactors that were built by the South Koreans, or collaboration between the UAE and South Korea, on time, on budget. They are now out in the market taking offers from multiple countries, multiple entities to build four more large units. And one major reason for this is that they are expanding their AI data center capacity substantially, and they want to power that with nuclear. And that's a trend that just popped up, in the last 6 to 12 months and is growing very, very quickly. But the demand side, not only do we have an increased interest in building new nuclear, but we're also seeing a lot of life extensions of existing plants. And that really moves the needle more than anything in the short, and let's say the near to midterm is when an existing reactor operator expects their reactor to shut down in 2030, then they get a 10 or a 20-year life extension. They've got to come into the market to buy material to operate that facility beyond its planned shutdown. So we've seen South Korea say that they're going to life extend 10 of their operating reactors that were set to shut down in the next 6 to 7 years. All of those are going to be life extended. France had talked about life extending a large part of their fleet. They've got 30, I think it's 32 of these 900 megawatt reactors in operation that came online between the late 70s and early 80s. They're going to give all of these 10-year life extensions, and they have the green financing from the EU in order to do so. The United States, of course, has the Inflation Reduction Act and the clean energy production tax credits that are in place currently that's de-risked largely the fleet. Not only are we seeing life extensions, I believe that there's 6 applications with the NRC right now to extend reactors from U.S. utilities, as well as an actual restart of a shuttered plant. That's the Palisades reactor in Michigan that is going to be restarted by Holtec. They're going to have to come into the market and buy uranium. So across the board, almost universally, with very few exceptions, which would be Spain is sticking to their phase out plan. Germany has yet to announce any restarts, although we think that they will actually restart at least a few of their reactors. I'm not going to hold my breath on that one, but we think it's probably highly likely. But besides a couple of holdouts, it is almost universally across the board positive, supportive of nuclear. We think that we see a 4 to 6% compound annual growth rate in the demand for uranium based on the growth of nuclear from now, basically going out into the foreseeable future.
Yeah, Justin, it's nice to see all these reactor builds and, like you say, life extensions being a key part that really doesn't get enough attention in the media, but it's very important for the sector. We also are seeing things like the Russian sanctions play a factor in the uranium price. So maybe speak to how, maybe not on the reactor side, but just on the trade and sanction side of things, how that plays into the uranium picture.
Well, I think the highest level and simplest takeaway is that it's not making things any easier. It's not going to have downward pressure on the price, and it's not going to make things any easier for utilities procuring material. The biggest factor I think that's coming into play right now is that any utilities that have, let's say, legacy contracts with Russia, especially going out, let's say, 18 months from now into the future, if they have near-term deliveries, they're either going to be buying expensive Chinese EUP, enriched uranium product with a 30% tariff to make up for not being able to import that material from Russia. Or maybe they'll be able to get waivers from the DOE if they can prove that they cannot find it elsewhere at any price or that it's in the national security interest to do so. So the short term, we think that utilities will find a way around it. The long term, essentially, 90 days from now or 85 days from now, this is literally against the law to import material from Russia. So there's a couple of implications of that. If you have a legacy contract with 10X, which is the Russian Enrichment Corporation that's state-owned, and let's say you have material that's supposed to be delivered in 2028, for example, right? The way that this works with 10X specifically is that you will actually receive your material of enriched uranium from that contract, from that enrichment contract. And then you will send back to Russia the feedstock that theoretically would have been required to produce that material. Whereas if you sign an enrichment contract with Urenco or Orano in the West, you have to provide that feedstock up front, which is UF6. So you either have to buy UF6, which you can't because there's none available, or you buy conversion, the service, and you buy yellow cake. You buy U3O8 uranium and you send it to a converter. That gets converted, and that UF6 goes to the enricher, and they literally use your material and spin it through their centrifuges, send you back the enriched uranium. Well, if you buy that enrichment from Russia, from 10X, they'll send you the material first, and then you have to send them what is the industry refers to as reverse feed. So some entities have enrichment contracts with 10X 27, 28, 29, 30, and beyond, and they don't have the feedstock for that material because they didn't have to have it until after they received it. So what that means is if you have an enrichment contract with Russia for those periods of time, you're going to have to source enrichment elsewhere. And if you don't have the feedstock, you're going to go have to buy it. So this is an important element to this equation. There's been a number of pretty bad kind of uninformed takes that this is a nothing burger, that uranium is fungible, it doesn't really matter, they're just do swaps, whatever. Not necessarily. It's not exactly fungible. UF6 is fungible. U3O8 is fungible. EUP is not, because your reactor that you're operating has a certain enrichment requirement, and you're not going to put EUP into that reactor that's vastly different in its enrichment level. So it can be fungible, but it's not universally fungible. So there's a lot of nuance to this, Shad. And long story short, this is complicating things for US utilities. It's also complicating things for non-US utilities that have fuel fabrication contracts in the US. If you have a fabrication contract from a US entity and you have to provide that enriched uranium to that entity in the US to have it fabricated, well, if that enriched uranium that you're sitting on comes from Russia, you can't send it here anymore. So it's definitely something that is complicating the fuel cycle. And at the very least, we're going to see rising prices probably across the fuel cycle, definitely for enrichment, most likely for conversion, and we could see it for U3O8 as well. To add a final point to this, Shad, the important element to this legislation passing is that it unlocked funds for the support of the domestic nuclear fuel cycle. 2.7 billion in funding was contingent on this passing. So now that it has passed and will become law in 90 days, that funding will be available. We're going to see RFPs coming from the US Department of Energy for enriched uranium and for conversion. Those RFPs are going to support those two elements in the United States and hopefully also help to fund expansion of those services in the United States, because that's really what we need more than anything to get off of a Russian reliance. There's also elements within the laws within this bill that require domestic uranium for those services. So this is going to support the miners, it's going to support conversion, it's going to support enrichment across the board. Going to hurt for a minute for utilities to get off of this drug, but once they're off, it's going to be very, very positive for the United States energy security and national security. So I applaud the move. The industry is not happy about it, but it's going to pass. It's going to be complicated in the beginning, but it's going to be a very positive thing in the long term.
Yeah, Justin, a little bit of short-term pain for long-term gain. And like you say, getting people off of the Russian processing and enrichment side of things and maybe bringing a little more of that into the domestic, and then also shining a light on domestic supply, which helps the uranium companies in the U.S. and other friendly nations trading with the U.S. So it should be a good thing overall for the West, but maybe a few blips and challenges in the short term for utility companies. Also, I think it'd be nice just to check in on some other big areas of supply. How are things going in Kazakhstan? How are things going in Uzbekistan? And then also, what about the French Urano supply coming out of Africa? Any thoughts on any of those other centers of supply on the global scene?
I suppose we can start with the French in Africa. Things seem to be stabilizing a bit in Niger. Orano has been able to restart their operations there. It's still not, let's say, as smooth as it was in terms of importing and exporting, importing reagents, exporting uranium. Their production is still going to be somewhat impacted negatively out of Niger for 2024, but it is back into operation. But either way, they probably lost, 4 to 6 million pounds of production based on just due to the coup that started in July last year and the implications from that. So it's certainly not a smooth situation for them, but it is getting better slowly, knock on wood. If we look at Kazakhstan currently, we are expecting a market update from Kazakhstan in August, which is delayed from their typical flagging of future production. So we expect them to tell the market what they expect to produce in 2025, and that messaging is going to come in August. What's happening in Kazakhstan right now, primarily, is they have a shortage of sulfuric acid. They don't have enough sulfuric acid in order to expand production anywhere near what they said that they would. Why? It's very expensive. So the entities within the country that are producing, I believe it's about 3 million tons per year of sulfuric acid, could be a little bit more. They are charging in very, very high prices. And not only that material is prioritized for agriculture, but the material that can be sold into the market and sold to Kazatomprom is extremely expensive. Imports are expensive. So the sulfuric acid market is very high priced. And Kazatomprom and the joint ventures don't want to pay up for it if they don't have to. So there's that element to it. The other element is that Kazatomprom is building their own sulfuric acid plant, an additional plant. They have two plants now that produce, I believe it is 680,000 tons a year combined. It might be a little bit more off the top of my head. They're building another plant that is supposed to produce substantially more so that they can then produce, I believe it is 1.5 million tons per year once this plant is built of sulfuric acid. And they currently consume just over 2 million tons per year right now. If they want to expand their production to the level that they had stated they intended to, which is 100% of their subsoil use contracts, or about 30.5 to 31,500 tons per year, roughly 80 million pounds, they're going to need north of 3 million tons per year of sulfuric acid. It's a big ask. There's other complications currently. The expansion of the Budenovskoye 6 and 7 deposit. This is a new deposit. It's a joint venture with Russia, is going very, very slowly from our understanding. It is not being developed on time. This is a deeper deposit. It's higher in carbonates. It requires more acid. It requires a lot of acid for that initial impregnating of the ore body. So all of these things are conspiring to basically say, we don't think they meaningfully increase production for a number of years. They're not going to be producing 80 million pounds in 2025 or 2026, and probably not even 2027. I think we'll see some increased production. It'll be incremental. It won't be a massive boost to production like they had initially told the market would be happening. As far as Uzbekistan, it's kind of Kazakhstan light. We were expecting them to double their current production, which is about 8 or 9 million pounds a year by 2030. They came to the market about 6 months ago and said, yeah, that's not happening. We're shooting for a 50% increase in production. So we'll get another million pounds a year out of the Uzbeks going forward for the next 5 years. And that's about it.
Okay, Justin. Well, let's now pivot maybe more domestically to North America to some of the supply. Actually, just saw Tim Getzel from Cameco at the Washington, D.C. symposium, the Energy Transition Metals Conference, and he was just speaking about the long journey they had during the bear market and coming out of that, and where their supply is going to be coming from. When you get a read on Cameco, what's your takeaway as far as the supply coming out of the biggest producer in North America?
Cameco, I think they're going to be able to expand McArthur River to the extent that they're saying. So they're currently shooting for producing 18 million pounds this year from McArthur River after restarting it over the last 18 months. And they're stating that they plan to get that to nameplate capacity for the mill, which is 24, 25 million pounds per year. I think they will be able to achieve that, but it's going to take multiple years. It's going to cost a lot of money to do it. But that's probably going to happen. So I think we expect that. Cigar Lake is a little bit more of a question mark. The phase one of Cigar Lake is essentially mined out in the next few years. Cameco has already stated that their share of the capex to expand into phase two of Cigar Lake, or what they call the Cigar Lake extension, is $300 million. their stake, and it's a joint venture with Orano. So, and phase two, from our understanding, is a little bit more complex geochemistry, possibly higher overall all-in sustaining cost to mine material out of that deposit. But they're going to make it. They also have good assets in the United States. They never talk about these, but most likely they'll be producing on those this decade. We have not heard anything on further, let's say, M&A coming from Cameco. Is that something that could be on the table? Sure. They tend to kind of fade that idea, basically claiming that they have 800 million pounds of uranium in the ground and their own assets that they can mine going forward, which is true. They've been doing a bit of exploring on the other side of the border from ISO Energy's Hurricane deposit. Basically, this deposit runs across the border, and Cameco's side of things, they've been exploring on that, hitting some high grades. So very curious to see how that develops going forward. But Cameco's Inkai is probably the most problematic out of all of their production profiles, and that's the joint venture with Kazatomprom. Same reasons that I just discussed that are kind of impacting Kazatomprom's operations with their other joint ventures are also the same impacts having with Inkai. Sulfuric acid issues. Cameco does not want to receive material coming out of the port of St. Petersburg, so they've elected to only receive it coming from the western route, which goes through Azerbaijan and various other countries. It's a very complicated route, takes much longer, it costs much more. So they've had delays on deliveries of material from Inkai. But Cameco is sitting in a pretty good seat here. They have a delayed reaction in terms of their contract book and the pricing. So you'll see that their realized prices are well below the spot and term prices currently, but it's a delayed reaction because they signed a lot of contracts at lower prices, and now they're signing a lot of contracts at much higher prices with much more favorable terms. So contracts they signed 5 years ago would have been partially spot reference, partially fixed with ceilings. And now what we're hearing is they're signing contracts that are entirely referenced to the market with very high ceilings, if any ceilings at all, with floors that are around the term price right now, which is about $80 a pound. So as the years pass, they're going to be printing money hand over fist at these prices and the prices they're signing right now. So they're in a pretty good seat. And that's not even to mention the Westinghouse, 49% ownership of Westinghouse. This is a full-on nuclear renaissance, and this particular ownership has incredible blue sky for the company as well.
All right, Justin, appreciate the update on Cameco and the way you're reading things. Let's also pivot over to U.S. production. I had an interesting meeting with Scott Melby of Uranium Energy Corp at that conference in D.C., and we were just talking about the perception that there's really no production coming out of the U.S., but we rattled off a handful of about half dozen companies. If you think about UEC, Encore, Your Energy, Energy Fuels, Peninsula, and as you mentioned, even Cameco having U.S. assets. What's your take on U.S. production as it seems to be ramping up this year, but really is going to be ramping up in a bigger way next year?
I'm very bullish on U.S. production. I think that the U.S. mining companies are going to see premiums. Everything is pointing to long-term support of nuclear and the U.S. nuclear fuel cycle. So I'm very bullish on U.S. miners. We're starting to see the gears turn on supply response, just to speak generally, but that's also the case in the US. Now, will we ever produce in the United States again enough uranium to satisfy our annual needs? I don't know. I think that's pretty unlikely unless we see development in some of the states with very large deposits of uranium, like Virginia, Arizona, New Mexico, et cetera. But for now, if we see all the players that are currently producing or plan to be producing in the next couple of years, we could easily see 5 to 10 million pounds being produced in the next 2 or 3 years annually out of the United States. And I think on a 5 to 10 year time frame, we could easily see 10 to 20 million pounds being produced and potentially even more. Really just depends on the pricing environment. If it sustains relatively high for that period of time, sufficient for these projects to get into production. But out of Texas, we've got UEC and Encore Energy. In Wyoming, we also have UEC and Encore. We have UR Energy, Energy Fuels there as well. Energy Fuels and a bunch of other smaller projects in Utah. And then you have Cameco's projects in Wyoming and Nebraska. Encore has projects in South Dakota. Peninsula also, I miss Peninsula. In all of these areas, most of this is ISR. There's a little bit of dry mining sort of mines happening in Utah. But if all of these projects get into production and even come close to their nameplate, we should see, 10 to 15 million pounds and potentially more on, let's say, a 5 to 10 year time frame. So it's very, very positive for the U.S. And of course, U.S. allies have an enormous amount of uranium. So we should be fine in the long run. But yeah, I'm very bullish on the U.S. miners.
Well, and while we'll definitely get over to the Athabasca Basin for exploration, I just want to ask you a quick one on what we're seeing in U.S. exploration. I've noticed a few new companies cropping up and a little bit more focus on U.S. exploration. Do you think there's any potential for some good new discoveries, or because it's been worked for decades, have most of the discoveries already been made in the U.S.?
Most of the discoveries have already been made, in my personal opinion, in the US. I don't think we're going to see any blowout drill results anywhere. The high grade uranium is in areas that is just not mining friendly. The highest grade uranium in ISR projects are in New Mexico, and the highest grade, just general kind of dry mine, underground mine deposits are in Arizona in the Arizona Strip. And both of those areas are not very uranium mining friendly, at least right now. It's going to take a lot of, let's say, social work in New Mexico, and it's going to take legislative work in Arizona. So outside of that, the grades are generally lower in the United States, but there's decent ISR grades, very decent ISR grades in both Texas and Wyoming and the surrounding states in those areas. So I don't think we're going to see any monster blowout exploration success. There's been a lot of exploration done in these uranium areas. A lot of it is oil drilling exploration that's been done over the years, and the data is all out there. So I don't think we're going to see any major exploration news coming out of the United States, in my personal opinion.
Well, let's shift over to the hot spot of uranium exploration, the Athabasca Basin. There are so many new companies, and we were talking about some of them off mic before we got on here, Justin, but there's a lot of new focus. There's been a staking war going on there. There's a lot of companies that have sold up a lot of land, and it's exciting to see that some of these companies are funded and they've got a lot of drilling planned for this year. What's your take on exploration in the Athabasca Basin?
Yeah, it's definitely heating up. I mean, I think the discovery that was made by F3 got people pretty hyped up. It's looking like a very, very good discovery for that company. I think that the exploration is always exciting in the Athabasca Basin, and now that the money is flowing into the sector, the ETFs are buying these stocks. If they're large enough to be held by the ETFs, they can benefit from that and dilute less. Exploration is expensive, so it's very difficult for the smaller companies that aren't large enough to be held by the ETFs to have meaningful drill programs without diluting shareholders to a large extent. With all of that said, there's quite a few companies that are out there drilling right now, and I think that during this bull market, explorers hit something good as things are all frothed up and everybody's bullish. It can be a huge boon for shareholders and for the companies if they hit something decent. I think we're going to see more discoveries in the Athabasca during this bull market for sure, based on the amount of exploration that's happening now. We should see in the coming years at least a handful of good hits and potentially even some new developments.
Well, and you bring up an interesting point there on whether the smaller companies are included or not included in the ETFs. Have those ETFs, things like not just URA, but the Sprott funds, the URNM and the URNJ, have they changed the passive investive side of investing in uranium stocks to the point where you pretty much got to be in those to get the liquidity? Or are there still opportunities for investors looking for contrarian positions not in there that could maybe move more or move in a way different than the ETFs because they're not included?
Well, I suppose it always depends on the size, right? So if you're investing a smaller amount of money, you certainly can have an advantage by being able to invest in the smaller companies without having large liquidity requirements and even more so investing in private placements in some of these smaller companies that are trying to raise cash to explore and build out their business. That can be a huge opportunity for accredited investors. But for retail investors, there's a lot of underperforming stocks that are not held by the ETFs that don't have great liquidity. That if you can position yourself into those companies prior to them growing large enough to be held by the ETFs or having some sort of exploration success, you can have, orders of magnitude greater returns in terms of percentage versus just buying the ETFs or just buying the large cap. So it really just depends on your liquidity requirements. Generally speaking, I think it's good to have a foundation to a portfolio of large caps and or ETFs, but you can also outperform the ETF significantly if you choose wisely. So, for example, since we launched our newsletter in August of 2019, we are now up about 460%, where URA, including dividends, is up about 250%. So, we've almost doubled the returns of the ETF. And since we incepted this newsletter, there's been periods where we've underperformed, periods where we overperformed, but on balance, we've chosen wisely and have been able to have a diversified portfolio of 10 securities and still significantly outperform the ETF. So, it's important to do that work. But if you need liquidity, you only have so many options. If you want to invest, tens of millions of dollars into this sector, you can buy SPUT, you can buy Cameco, you can buy NextGen, you can buy Paladin, you can buy Denison, and you can buy the ETFs. And that's pretty much it if you need a certain amount of liquidity. And that's always been the challenge for this sector in attracting big money is liquidity. So as the sector grows, as liquidity improves, we believe that that size will beget size. We do know if you're managing a large amount of money and you want exposure, let's say you get the story, you're bullish, you see that the price is going up, you see, kind of the future outlook for the sector. What do? You open up your Bloomberg and you look up the top 5 most liquid things that you can buy in the sector, and then you buy those. That's it. You don't do a discounted cash flow. You don't do any work on the securities. You just buy what is liquid and exposed. That's it. And so as liquidity improves, we're going to see more and more big money players come into the sector. And as they buy the ETFs buy the underlying holdings. It's what we call the flywheel effect in the sector. And that's you can greatly benefit from that if you're positioned in what the ETFs hold. But that's a very long way of saying you've got to do your own research. You really have to make your own choices based on your own needs, your age, your risk tolerance, the amount of money you're wanting to invest, et cetera, et cetera. All of those things matter, and it's I can't really give a one size fits all answer.
Yeah, I appreciate that feedback. And I think you're right that a lot of times it's a liquidity factor more so than a stock selection factor. I think that also plays into companies that have a dual listing on the big board in the US as well as Canada. It allows more liquidity into those stocks, maybe not just based on the fundamentals of the company, just based on access, where sometimes investors or funds can't access the OTC stocks. But I want to bring up another question here because we've had a few people email us, Justin, about should companies that are doing the offtake agreements, now that utilities companies are in the game talking to the uranium mining companies, are they limiting their future growth by doing it, or are they securing a better way for analysts to look at how to value them 5 years, 10 years, 15 years out because they have these contracts? Because we've seen some companies pick off long-term offtake agreements that are at much lower prices than what we're seeing now. And people think, hey, if uranium keeps running, are they shooting themselves in the foot, or should they be more unhedged to the price? What are your thoughts there?
Again, it depends on the company. It depends on the jurisdiction risk. It depends on how far along the company is in developing an asset. It's very hard to say. Again, there's not a real solid one answer for this across the board, but I think generally speaking, a good mix is to reserve some of your future production capacity for either spot market sales or market reference contracts, and securing some at least partially fixed price contracts or market reference contracts with floors is important during development. And it's important during development because you can actually de-risk that development by having some cash on the books, having some future commitments on the books. And if you need to take on debt in order to develop, then usually the financiers also want to see that you have forward sold some of that capacity. You have some future profit on the books. So it just depends on the project. I think to say we're not signing any contracts at all, so we have 100% exposure to market prices when we are producing. It's kind of a cute thing to say, but it's not the most responsible way to operate. I think if you can sign some market reference contracts with floors, that's way better than just saying we're staying exposed to the market. And if you're going to sign those kinds of contracts, usually you need to be holding some uranium. That will help you in those contract discussions because there's always a risk that the development will not happen on time and the utility signing that contract's not going to get their material. This is one of the reasons why NextGen, for example, just made a deal with MMCap, took on some debt with a convertible debenture to buy 2.7 million pounds. Why? Well, having those pounds on their books will help to de-risk those conversations with utilities. So if they are going to sign a contract, let's say for 2030 delivery of 2 million pounds, well, they've got those pounds on their books. And in case anything goes wrong in that development, they can still deliver into that contract. So it's important to own some uranium physically on your books if you are developing. It's also important to sign some contracts that at least have floors or some partial fixed price, while also keeping some of your capacity open for the future pricing because nobody knows where this is going. The general consensus is that it's going up. Is it going to settle out at 150 or is it going to breach $500 a pound? Nobody really knows. But we know it's going up, and to maintain some exposure to those potentially very high prices is obviously a wise thing to do for any developing company.
Yeah, good thoughts. And I was going to ask you about next gen and that purchase of the uranium, but you make a good point. It de-risked the conversation, and a lot of utility companies want to see that security of supply before they make the deal. So that probably plays into the thinking there. I guess final question here, Justin, final Jeopardy. M&A. We saw a lot of it a year or two ago, but now we've seen this divergence. And as you noted, some of the companies have done very well if they're included in the ETFs and if they are near production or are going into production or at least a solid developer. But there's a lot of companies that haven't moved nearly as much. They've kind of been left behind. So it creates this bifurcated market where there's the haves and the have-nots. Do you think some of the haves that have the higher share price are going to start using the currency of their shares to acquire some of the smaller exploration companies?
I do think so. And we saw one piece of evidence of that a couple months back, which is Boss Energy, based out of Australia, was able to issue some arguably very heavily valued paper in order to acquire a 30% stake in Encore Energy's Alta Mesa project, which flushed the company with cash. And it was a good move, I think, for both companies. I think we're going to see more of that. I think that there's a handful of companies in this sector that are priced at a premium right now based on $91 a pound uranium. Are they at a premium at $150 uranium? No, they're not, but they're at a relative premium. And I think that these companies should be issuing paper and taking advantage of some of the lower priced companies with good projects. I think we're going to see more of this going forward. Of course, it's still a very, very small sector. So how much of this we're going to see, I don't really know, but I think we're going to see more. I think we're going to see more in the Athabasca Basin. We're going to see more in the States, could even see more in Australia and potentially Namibia. I think we're going to see a lot more M&A going forward. But because the sector is so small, it doesn't happen all the time. We'll see one or two deals a year, and that's probably going to be the way that it's going to happen going forward as well.
All right. Well, we'll wrap it up there. Man, Justin, I really appreciate getting your thoughts on the nuclear power industry, on the fuel cycle, and then diving down into the uranium companies and how that plays a role in what people are investing in, both domestically and abroad. If people want to follow along with Justin's work, definitely click on the link below this interview. It takes you over to Uranium Insider, and you can follow along with Justin and the service he offers to people following the sector night and day. And Justin, appreciate you spending some time with us here at the KE Report. As always, looking forward to our next conversation.
It's always my pleasure, Shad. Thank you for having me on again.